In this video, I'm going to be guiding you through Chapter 4.2, Fiscal Policy. Before the government can spend any money, it needs to know whether it has the budget in order to do so. The government budget is its financial plans in terms of planned revenues through tax and expenditure. A deficit is when spending is higher than its revenue, and a surplus is when its revenues is higher than its spending. And when it's balanced, revenues are equal spending. And now we look at the reasons for government spending. The first reason is to influence economic activity, especially in times of recession. And in order to boost the economy, they spend money on public goods to create additional jobs, and also they subsidize firms to increase its output. Without the additional government spending, countries will find it quite hard to get themselves out of recession or grow. The second reason is to reduce market failure. This is to provide the economy with underproduced goods and underconsumed goods. The third is to create a multiplier effect. What this means is that the initial injection of money from the government will increase aggregate demand by providing jobs and investment in infrastructure. And as income increases due to this, they start spending within the economy. Because of the additional spending within the economy, businesses will receive more revenue and profits, which leads to their employees receiving the income and spending it within the economy too, creating a multiplier effect. Another reason for government spending is to promote equity. This is to provide for the poorest and vulnerable groups in the country. Some examples include unemployment benefits, an education allowance for your child, direct cash transfers to the poorest in society, and generous tax credits and reduced effective tax rates for the vulnerable groups. And the last reason for government spending is to encourage environmental sustainability. This is by subsidizing sustainable production and renewable energy for businesses. Now moving on to taxation. There are a good few reasons for taxation. The first is to redistribute income, which lowers the gap between the rich and the poor in the country. Tax is also used to discourage demerit goods. This reduces the quantity of harmful goods consumed within the economy. It is used to adjust and manipulate the influence of total demand. And it encourages environmental sustainability to meet the government's environmental sustainability goals. One example can be the use of carbon tax credits. So now we look at the different classifications of tax. The first classification is a progressive tax. This is widely used in most economically developed countries. A higher percentage of tax is applied as your income increases. As you can see in this diagram, as your income level increases from Y1 to Y2, the tax rate increases from T1 to T2. The next classification of tax is a proportional tax. This is when the percentage paid in tax is exactly the same no matter what your income level is. For instance, if your income increases from Y1 to Y2, the tax rate stays the same at 20%. And lastly, we have regressive tax. This is when the percentage paid in tax falls as income or wealth rises. As your income level rises from Y1 to Y2, the percentage of tax decreases from T1 to T2. Now moving on to direct taxes. There are a few different types of direct taxes that the government can directly take from you. The first is income tax. This is a tax on income, and every person that is employed within the economy will largely have to pay income tax. The next tax is corporation tax, which is the taxes on profit. Capital gains tax is the tax on profit made on assets which were sold at a higher price. For example, you purchased a home in the UK for £1 million. 10 years later, it is now worth £2 million. So you have experienced £1 million in terms of appreciation. If you go to sell that house, the £1 million that you gained is now taxed. That is called capital gains tax. And lastly, inheritance tax. This is a tax on wealth above a certain point, which is then passed on to the other people upon death. Now, I personally think inheritance tax is silly because one will work roughly 30 to 40 years of their life, accumulating assets and wealth, and instead of passing on the title deeds to my property, my stocks, my assets, my gold, to my spouse or offspring, the government feels the need to take a 40% cut from this before the assets are passed on. Ridiculous. There are also other forms of tax, such as indirect tax. These include sales tax, which is applied on most goods and services within the economy. Some countries have exceptions to this, such as baby food, baby products, and foods that are good for you, such as vegetables and fruit. Next, we have excise duties. These are taxes charged on certain demerit goods, such as petrol, tobacco, and alcohol. These are in addition to the sales tax. And lastly, we have customs, also known as tariffs, and these are taxes on imports. Moving on to the impact of taxation to different stakeholders. For consumers, the taxes will increase the cost of goods and services within the economy. This will reduce the aggregate demand for goods and services. Tax is usually shared by firms and consumers depending on the elasticity. Consumers will pay more of the burden of tax if the product is inelastic, and consumers will pay less of the burden of tax if the product is elastic. And in the case for workers will experience a loss in disposable income due to an increase in tax. This reduces their purchasing power, and they will have less incentive to work more hours due to higher levels of tax. And for firms, this increases their cost of production, as too high rates of tax will incentivize firms to move abroad. Costs can be passed down to the consumers, especially if the product is inelastic. But if the products that they offer are elastic, then the costs will be absorbed. And the impact for the governments. Taxes are the main sources of revenue for governments, which allows them to spend on public goods and merit goods, and the society will benefit from governments spending into the economy. And in the case of an economy, high taxes will reduce the aggregate demand within an economy. This is due to less disposable income and less money used for investment. This may discourage new entrepreneurs to start new businesses due to high levels of tax. And some indirect taxes are regressive, increasing the gap between the rich and the poor, and taxing specific demerit goods will reduce consumption of them, such as cigarettes, alcohol, and sugar, which is good for the economy. Moving on to the definitions of fiscal policy and the changes in taxes and government spending. The definition of fiscal policy is the decisions on government spending and taxation taken to influence aggregate demand in the economy. Now, in the case of changes in taxes, the effect on this is that it can reduce government revenue. This will cause government budget deficits, which will lead to higher levels of government borrowing. However, lowering corporate taxes can attract foreign and domestic investment within the economy, which will stimulate aggregate demand. Looking at the effects of the changes in government spending. Firstly, government spending without government revenue will cause a deficit, but spending on public goods like education can boost productivity of the economy in the long run. Changes in spending will directly alter the budget balance. Here's a fun fact: most economically developed countries, their governments are in debt. One of my favorite examples to use is America. They currently have $36.933 trillion of national debt. That's the equivalent of $107,000 per citizen, or $323,000 per taxpayer. And lastly, the effectiveness of government spending can differ in the short run and the long run. And now we move on to the effects of fiscal policy on government macroeconomic aims. Firstly, fiscal policy is used to boost economic growth. As they spend money on infrastructure and reduce taxation, the GDP will be increased. Fiscal policy can also control inflation, as they can set low taxes which will boost productivity levels, incentivizing expansion and jobs. Another way to achieve low inflation using fiscal policy is for the government to spend less within the economy. This decision is usually very highly unpopular as it causes austerity. The third macroeconomic aim is employment, as cutting taxes will incentivize people to be employed. This is due to the higher levels of disposable income received by the individual. Governments can also redistribute income using fiscal policy, as they can provide very generous state benefits to support the low income. As they can provide very generous state benefits to people that are on very low income within the economy. And lastly, the environment. As governments and economies strive for a more sustainable future, the government will heavily tax the use of fossil fuels and at the same time subsidize the firms that are using eco-friendly practices such as the use of renewable energy. And lastly, we move on to the limitations of fiscal policy. Firstly, there are time lags, as it takes a long time for the economy to feel the effect. This assumes that the government has got enough money to spend on these public goods, as without money, they cannot spend. And as I said before, when governments don't have enough money, they start to borrow, so their debt burden will increase, which will harm the future generations. And lastly, it really depends on the government's priority. For example, if the economy was in a recession, their first priority is to ensure economic growth and the reduction of unemployment. And unfortunately, the environment will take a back seat. I hope this helps. I hope you guys have a good day. Bye-bye.